Everybody, welcome to the Wednesday live stream. This is everybody's favorite topic, which is taxation. And when we're going to talk about taxation, I always bring my friend along, Andrew Gordon. Andrew from Gordon Law. Welcome back to the show, man.
Well, great to be here. And as you know, taxes are my favorite topic to talk about. And I mean that seriously. So I'm excited to be here this morning and for the Senate hearings today.
Yeah, exactly. So everybody, because when taxes come due, we're always kind of thinking about it last minute, except for some of us who I have to constantly keep thinking about it, whether that because you're planning for the future or you have your own corporation or whatever else it is. But if you're looking for different helps and aspects of that, there's a link in the description. You can find Andrew Gordon on his website. Also, you can definitely follow him on X. Great information that he gives out. And today we're going to be talking about the Committee on Finance, talking about the taxation of digital assets. But before we get into that, I had to ask Andrew this. Andrew, how did you get the handle on X at accounting? Like, how long have you been on X? Because everybody gets like these long drawn out handles, but not you, at accounting. How'd that happen?
No, we've been on X for a while, I guess before Twitter, obviously. But yeah, one of our clients had a number of early, simple X Twitter handles. And several years ago, he gave us this one. So it's something that I've been very fond of because it's easy to remember. And it's a great handle. So thank you.
Yeah, at accounting. Well, speaking of things not easy to remember, let's break into what's happening for the Senate as they are going to go, let's see, live right now. Let me make sure everybody can hear this crystal clear. I'm going to bring this up the tab. And away we go. And actually, before we start listening, because it's all, the basic intros, Andrew, what is the significance of this today? Why are we so hyped up about this? What's going on here?
Yeah, well, first of all, I get it. Taxes, not sexy, not a topic people even like to think about. But ironically, if you ask many crypto investors what keeps them up at night, a response you'll often hear is taxes. In fact, you might be watching this and thinking, well, yeah, taxes is something that in crypto has been a thorn in my side since the beginning. And it shouldn't be that way. Crypto taxes are unlike taxes in any other area of the modern economy. With your wages, you get your taxes withheld. If you trade stocks, someone gives you a report. With crypto taxes, as you all know, it's on you to report. No one gives you a nice polished report at the end of the year. And if you don't do it right, the IRS can audit you, send a notice, penalties. And for those that even try to just do it the best they can still face those same problems. They're too complex. They're not fair. And if we want crypto to grow in the US, it's my true view that taxes are the number one area. Stable coins, great. Market structure, great. But I don't know how many of the people watching out here are going to directly launch coins and care that much about market structure, although it's great, but everyone that watches is touched by taxes.
Very true.
And that's something that we need to fix. And today, Senate, first of its kind hearing on this exact topic. What's going on with crypto taxes? Many of the senators or several of the senators on the Finance Committee I've spoken to, they understand these issues. I'm looking forward to the questions that they're about to ask about these issues, because from things like staking to just being able to buy a cup of coffee with crypto, there are a lot of problems. I'm excited to see what happens today.
Yeah, and we've already got questions rolling in, which we will answer. Andrew's got a hard stop in an hour, so we'll answer all those questions later on. But this is good, especially for Andrew here, to get this information because he actually goes to Washington, D.C. and talks to these politicians. So let's see what they've got to say. Let's get into it.
Public request for information on how Congress should address the tax challenges and opportunities presented by digital assets. The robust input we received from stakeholders showed significant uncertainty exists, and Congress should update our tax code to provide clear and durable rules of the road. Since receiving that input, the market cap of digital assets has continued to rapidly increase, and additional questions have been raised by industry. Many of my colleagues on both sides of the aisle understand these challenges and have put in significant work to develop thoughtful solutions. This summer, Congress passed and the President signed into law the Genius Act, which establishes a first-of-kind framework for payment stablecoins, an important step for the American leadership in financial innovation and economic opportunity. As Congress considers additional steps to further develop the digital asset architecture, the tax treatment of these assets and transactions is a necessary part of that fabric. Currently, our tax code does not provide straightforward answers for many digital asset transactions. Whether someone is buying a cup of coffee, donating to a charity, investing, lending, mining, or staking.
Exactly.
Without clear tax rules, taxpayers are left with many unanswered questions, and individuals, businesses, and our country's finances bear that burden. Lingering tax uncertainty also makes the U.S. a less attractive place to do business and invest and hurts tax compliance. The U.S. must not fall behind in this rapidly growing market. It should be a leader in digital asset development. Recognizing these challenges, the Trump administration has rightly prioritized the examination of the current tax treatment of digital assets. During his first week in office, President Trump issued an executive order recognizing the crucial role the digital asset industry plays in U.S. innovation. In addition, the critical role that it plays in economic development and international leadership. That executive order also established a President's Working Group on Digital Assets Markets, which published a report titled Strengthening American Leadership in Digital Financial Technology. The report includes tax legislative proposals regarding the mark-to-market election, trading safe harbors, securities loans, and the wash sale and constructive sale rules for fungible digital assets. The report also includes tax recommendations dealing with payment stablecoins. These are novel and complex topics, and I thank our witnesses for being here today to help us better understand them. I look forward to learning from you and hearing how Congress can take steps to develop proper rules of the road for digital asset taxation to ensure U.S. leadership in this rapidly evolving industry. As we will hear from our witnesses, the cryptocurrency ecosystem is diverse in its products and functions, and our tax code must appropriately adapt to reflect a more comprehensive and durable approach. I trust the bipartisan foundation that this committee has built will result in solutions that meet that challenge. Senator Wyden.
Thank you very much, Mr. Chairman. Mr. Chairman and colleagues, 10 hours into a government shutdown, and Americans are wondering this morning how they're going to afford groceries, pay rent, and even cover the transportation costs they face today. The Republican response to them? Silence. With so many people being hurt by the shutdown and desperately worried about the hardships to come, I think it is so unfortunate. The Republicans are making their warped priorities clear. I'll start with a few facts. The federal government is shut down while Republicans control the House, the Senate, and the White House. Rather than going forward in good faith, the administration is engaged in hostage-taking, threatening people's livelihoods, and just about everything except finding a solution. Republicans don't make any real effort to hold Trump to his promises or to stick up for federal
Gotta make
workers.
everything political.
They just rubber stamp
Every
whatever
time.
chaos
Never miss an
the
opportunity.
administration inflicts on the
Well,
country.
if you've got a
That's no matter
microphone,
the cost.
I guess you take advantage
So
of it.
millions
even
and
if it's at the
millions
cost
of
progress.
Americans now are facing
Exactly.
a huge
Opportunity
increase
lost.
in their health care premiums. This is the real world of the suffering we're seeing this morning. The Trump administration and Republicans won't lift a finger to help them. resolving this shutdown and getting our fiscal house in order really ought to be the top focus now of the Finance Committee. Unfortunately, there hasn't been a single hearing on the $5 trillion tax bill that was passed a few months ago. Biggest bill in history, committee with jurisdiction, not going to discuss it.
It's not like politicians get things done.
On top
They
of
just do
that, the
politics.
economy is showing real signs of weakness. Jobs are fewer, prices are higher. Millions of Americans are about to get clobbered with those healthcare costs. Now, I do agree with the concept of working on crypto's treatment under the tax code. It's a worthy subject.
Is this 1 hour?
I fought back against proposed rules that went too far.
I think it's about an hour.
What
It
code
doesn't-
independent
I don't think it has a
developers,
formal
not
length. It's
exchanges or
usually about an
brokers, would
hour.
be forced to write.
Who knows?
But
We
in
may
my
not even
view,
get into it.
And I say that this morning to my
Well,
colleagues.
if Wyden keeps
on all
going, yeah, that's all it's
sides,
going to be.
There's a pretty long list of
This
major
hearing has
issues
only
and
been
problems this
scheduled for about
committee
a week.
has
It's
got to look at first.
it's pretty
As for the
recent.
topic at hand,
Uh-huh.
there are a lot of questions that
Investor
deserve
PR has a
candid
good point.
consideration
Look
when
at
it
Puerto
comes to
Rico.
crypto
Pay
and
0%.
taxes.
That's exactly
Right
it.
now, there's a severe lack of
That's true.
certainty and clarity on
We
how
need you
tax
here.
rules
We need
apply
everybody to come to
crypto.
this place.
That's bad for just about
Well,
everybody.
the way to do it
except the
is
tax
fix
cheats.
taxes, so you
One of
don't
the
have to go
effects
to
of all
Puerto
that
Rico. It's
uncertainty
great
is
as
a
Puerto
big
Rico is.
increase in the tax gap,
Yeah, see
the
that.
taxes that go unpaid every year. Back in the first Trump administration, the IRS Commissioner Charles Rettig sat in this room and testified that the real gap might be double the official estimate because of the shadowy rules around crypto. That would make the tax gap almost
Not the rules,
$1.4 trillion
lack of
per
clarity.
year. Goes
Lack of
without
clarity,
saying,
exactly.
if the U.S. actually collected the taxes individuals and corporations owed, that'd go a long way to fixing our fiscal challenges. So there are a lot of other issues to consider. This is a new and rapidly transforming industry. It raises new questions all the time, including how to treat crypto firms that, for all intents and purposes, are basically like sports gambling companies. The Senate
Well, that
needs to
part is
handle
true.
these
You got
issues
a point.
carefully, take the time to get it right. That'll be a challenge, and I certainly hope that the Senate looks at this in a bipartisan way. Right now, what's most important is that we stand up for people who are suffering today, because they're all over America this morning. That's what they're thinking about. Thank you, Mr. Chairman.
Thank you, Ranking Member. And although this hearing is about crypto, I have to respond just briefly to the effort to relitigate the one big beautiful bill. The bottom line is that yesterday, the Republicans voted to keep the government open. And the Democrats insisted on over $1 trillion of new spending in order to do so. We will continue having that debate, but today we're going to go forward with our witnesses and discuss the issues that we deal with regarding taxation of digital assets. In a moment, our witnesses will share their opening statements. Before doing so, I will provide a short introduction of each witness. Mr. Soman Sato is the Director of Policy at Coin Center, a leading nonprofit research and advocacy organization focused on cryptocurrency and decentralized technology. Prior to joining Coin Center, he held senior roles in both the public and private sectors, focusing on the legal and regulatory treatment of cryptocurrencies. Ms. Kramer is the founding member of Ask Kramer Law LLC. Previously, she served as a partner at McDermott, Will, and Emery for 30 years. Ms. Kramer has also authored a 2-volume, 4,000-page reference, Financial Products, Taxation, Regulation, and Design, now in its 4th edition. Mr. Slotkin is the Vice President of Tax at Coinbase. He took on his role at Coinbase following a career of nearly 25 years at the General Electric Company and as a tax lawyer at a number of global U.S. law firms. And Ms. Nellen serves as the chair of the American Institute of CPA's Digital Assets Tax Task Force. She is also a professor at San Jose State University, teaching graduate level tax courses, and directs the university's High-Tech Tax Institute and Blockchain Tax Conference. She was previously with the IRS as a revenue agent and lead instructor, and also in private practice. We will begin with Mr. Somansato's opening statement, followed then by Ms. Kramer, Mr. Zlotkin, and Ms. Neller. Mr. Somansato.
Chairman Crapo, Ranking Member Wyden, members of the committee, thank you for the opportunity to testify today. My name is Jason Somansato, and I am the Director of Policy at Coin Center, an independent nonprofit focused on the public policy issues facing cryptocurrencies. Coin Center is not a trade association. We do not represent any particular company, sector of the ecosystem, or crypto network. Our work is focused on informing policymakers how best to approach this new technology in a way that upholds constitutional principles, safeguards civil liberties, and fosters innovation. On today's topic, Coin Center has long called for sensible and fair tax policy that protects the rights of individuals to build, use, and benefit from open blockchain networks. We do not seek special treatment, but rules that align crypto transactions with comparable activities under the law. This hearing presents an important opportunity to address the current obstacles to that equal treatment. But why act now? Since the introduction of Bitcoin in 2009, millions of people, including millions of US taxpayers, have used open blockchain networks to send peer-to-peer payments, to earn rewards, and to conduct a wide variety of other activities. These networks are not going away, as evidenced by the billions in value transferred over them each day. And there now is increasing demand to transition significant portions of the economy to blockchains, just as so much of commerce moved onto the internet starting in the 90s. Yet the tax treatment of crypto transactions is often uncertain, impractical, and in some cases fundamentally misaligned with well-established principles of tax law.
It's just wrong.
The resulting burden falls most heavily not on institutions.
Yeah, well, real quick, it is just wrong. And thank God these guys are all talking because, I mean, I think some of these people have no idea what's going on.
Institutional players, but on individual users and new market entrants, those least able to afford specialized tax advisors and expensive accounting software. Sensible tax reform is essential for US competitiveness and ensuring that these networks are built with democratic values. Whenever an American Bitcoin miner or Ethereum staker suffers unnecessarily complex tax treatment, whenever an American Solana user faces accounting headaches or invasive surveillance, we are not merely inconveniencing a handful of today's nerds and early adopters. We are ceding the future of financial infrastructure to rival nations promoting closed and surveilled network models. Congress can offer a better alternative, one rooted in clarity, fairness, and the rule of law. So how do we improve the current tax environment around crypto? My written testimony focuses on 3 recommendations that Coin Center has championed for years. Let me briefly explain each. First, the IRS treats cryptocurrency as property. That means every time a user sends crypto, even to buy a coffee or pay a fractional transaction fee, they trigger a complex taxable event. For individual users, this is comparable to triggering a tax obligation every time you send an email or a text message. In 1997, Congress saw a similar issue with foreign currency and created a $200 de minimis exception. A comparable fix for crypto would go a long way toward enabling everyday use without sacrificing compliance. Second, we urge Congress to clarify that block rewards, the newly created tokens earned by miners and stakers for validating transactions, be only taxed upon disposition. IRS guidance incorrectly treats these tokens as gross income upon receipt. The reality is that these tokens are not received, but are instead created property, just as crops grown by farmers or apps coded by developers. The current IRS approach leads to phantom income and misaligns crypto with other taxpayer-created property. Congress should clarify that block rewards are only taxed when sold or exchanged. That change would align the law with economic reality and prevent honest taxpayers from being penalized for participating in network consensus. Third, the 2021 Infrastructure Act extended Section 6050I to crypto. This provision now requires anyone receiving over $10,000 in crypto to collect and report detailed personal information about their counterparty in a peer-to-peer transaction. Coin Center has challenged the constitutionality of this provision in federal court, and we urge Congress to repeal or amend it to avoid chilling legitimate private uses of this technology. The promise of cryptocurrency lies in its ability to empower individuals and enable open, decentralized innovation. But that promise can't be realized if the tax code places unfair burdens on the very people working to build and use these tools in good faith. Congress has a critical opportunity to modernize the tax code, protect everyday users, and ensure the United States remains a leader in this fundamental technology. Thank you.
Ms. Kramer.
Okay. Good morning, and thank you for inviting me to join you for this important discussion. By way of background, my law practice relates to financial products and derivatives and trading markets. I wrote the treatise on financial products. I was an adjunct professor at Northwestern Law School for 20 years, and I've conducted workshops for IRS financial product specialists for over 20 years. And it's my privilege to share with you my views. The existing tax framework set out in the Internal Revenue Code is flexible enough to accommodate digital assets, with some clarification and residual gaps filled in by Congress. Yes, digital assets are a new asset class with unique transactions never contemplated before. But this is not the first time that a new asset class is available for trading, nor the first time that the code has been applied to a totally new asset class. In moving forward, we need to keep in mind the precedent we're setting for the next new asset class and the next one after that. As Jason said, the IRS has repeatedly confirmed in pronouncements that digital assets are property, and the tax code determines tax character, timing, and sourcing for property. Tax character, it's either capital or ordinary. Tax timing, it's going to be based on your accounting method and when you have dominion and control, that means the free use of the property. And source, geographic location, where the services are performed or the income is earned. As property, many digital assets also fall into the category of commodities, while a few of them are securities. And although stock and securities is defined in the code, without a code definition of commodities, the IRS has generally deferred to the CFTC as to what constitutes a commodity. We really need a code definition. So let's turn out to mining and staking rewards. The code tells us that gross income is income from whatever source derived. To have gross income, a taxpayer must have an accession to wealth that is clearly realized and over which the taxpayer has complete dominion and control. What does this have to do with miners and stakers who receive rewards for adding blocks to a chain or for validating transactions? Well, under current tax law, their rewards are taxable upon receipt once they have dominion and control. The awards are compensation for services. When a miner or staker adds a block to a blockchain or validates a transaction and subsequently sells those rewards, the second transaction is a separate taxable sale. There have also been questions about applying the mark-to-market rule under Code Section 475 to digital assets. At present, actively traded digital assets are commodities for 475 purposes.
Are you familiar with
How
this?
is actively traded defined and which digital assets meet this definition? Congress.
What's that?
Are you familiar with this aspect that she's talking about, the mark-to-market rules?
No. What's this?
It's in the tax code, there's a distinction between being a trader and an investor. We always talk about it very freely, right? If you're a crypto trader, you're a crypto investor, it means the same thing. But taxes, they actually have different definitions. In order to be a trader, you have to be trading regularly and continuously every day for set hours during that day, like an actual trader back in the day.
Right.
To go to the stock exchange, you have your hours, you trade, you're a trader.
Okay.
And if you are a trader, then you could take deductions, going to conferences, computer equipment, whatever that may be. And you can also do a special election called a mark-to-market election. And with that, you don't actually pay taxes every time you trade. You pay the taxes on the difference between what you started with at the beginning of the year and the value at the end of the year. Mark-to-market, pay the tax on that. But there's been this big dispute of, well, if you're a crypto investor, can you be a trader? The rules all talk about stocks, securities, those types of things. Can you, and what are the rules for a crypto trader? It's been largely undefined, but this is important, something we talk to people about pretty regularly when they trade frequently, right? A lot of people watching are this is what they do for a living. They don't have a W-2 job. They're trading crypto. So can they benefit from trader tax status, be able to take deductions, expense their home office, do all of those types of things? So it is pretty important.
Yeah, you would think it would be, but I mean, there's just so many gray areas. How can they? Yeah. Well, I mean, like we talked about on the last stream we did together, it really comes down to, as long as you're making the good faith effort to, put your information forward. It's something the IRS is kind of like, okay, well, we'll go with that one, because they're not getting guidance from Senate, the House. They're just like, this is as good as it gets. Is that what you've seen, or is it like, no, we're going to audit you now?
It's been both in terms of audit. I'd say, fortunately, when we defend the audits, if you've done your best, we've been very successful in getting rid of penalties. But for instance, even recently, we had to take a case to tax court to get rid of a penalty. The client reported the best they could, 21, 22, and IRS assessed an accuracy penalty, and they truly did their best. We fought it. We were able to get it reversed, but there should be a way that you can do your best, or that the system supports not having to have taxpayers do those calculations themselves, like with stocks.
Yeah, you know what? And then we'll get back to this. I mean, exciting stuff. But it seems like when you have somebody in your corner, or if you have legal representation and you're dealing with the IRS, I've had to do this myself. They're kind of like, they're more willing to do things for you when it's just you and they're steamrolling you. And it's kind of like, okay, damn it, now we got to deal with this lawyer and the actual client and the person. So we'll just, all right, no fees, because we want to keep going around and around and around. So that's been my experience personally.
It's very unfortunate, but in crypto taxes, having a good accountant, lawyer that knows crypto, that can advocate against the IRS, can mean the difference between having a substantial tax and penalty or not at all. We've had several times where people have come to us after trying to do it on their own, having other CPAs try. Happy to help, and happy to have the business. But we need a system where people don't need expensive attorneys. And look, none of the people, it sounds like all of the witnesses all represent big interest, right? Coin Center, Coinbase, even Miss Kramer worked at McDermott, Will and Emery. I don't think any of the people watching here can afford those lawyers, or that she's ever worked with an everyday investor. But we need to make sure that all of us have rules that protect us, and that you don't have to pay people like me, and certainly not people like the big law firms in order to handle these types of things.
Yeah, exactly. Well, let's get to this and see if we can actually get that done. All right, Here we go.
Congress needs to provide guidance so taxpayers can properly elect into mark-to-market as either commodity dealers or commodity traders. The scope of actively trading is unclear, and Congress needs to clarify when digital assets are commodities within the current code and what actively traded means. If digital assets are a new category, then it should be made elective for both traders and dealers to provide tax parity between digital assets and all of the other commodities. Let's finally consider the appropriateness of a de minimis exception. Precedent for a de minimis exception is available for personal use foreign currency transactions. The rationale given for granting the foreign currency exemption does not apply to digital assets, because people don't need to pay for a cup of coffee with crypto, while tourists abroad have to buy things in the local currency. A de minimis exception won't solve the record keeping and reporting obligations, because taxpayers still need to keep track of all of their transactions in order to demonstrate their compliance. And if Congress decides to provide a de minimis exception, it would be providing a tax subsidy to encourage crypto investments. So the bottom line is that Congress needs to provide taxpayers with guidance that as to the taxation of digital assets. Clarifications needed in key areas, and gaps need to be filled.
Hey, Andrew, what do you think about just fast forwarding this to maybe we can get to like the senators talking back and forth? Let's do that. I mean, the opening statements are riveting, but there's only so much. Damn it. Now Zlatkin's going to talk. All right.
Proof that we're serious about integrity, compliance, and fairness. The stakes are high. Done wrong, tax policy will create confusion, higher costs, and capital flight. Done right, it will protect the tax base, enable innovation, and preserve America's role as a world financial leader. Senators, crypto is here for good, $4 trillion strong, and now is the time to bring our tax rules up to speed. Thank you, and I look forward to your questions.
Thank you. Ms. Nellen.
Good morning, Chairman Crapo, Ranking Member Wyden, and members of the committee. My name is Annette Nellen. I'm chair of the AICPA Digital Asset Tax Task Force and a professor and director of San Jose State University's Graduate Tax Program. On behalf of the AICPA, I'm pleased to have the opportunity to testify on the taxation of digital assets. Despite the growing importance of digital assets and the increasing number of taxpayers using them, there is still a lot of uncertainty and a lack of clarity when it comes to many digital asset tax issues. Since the initial guidance from the IRS in 2014, the number and types of digital assets and their uses has grown and continues to do so. Digital assets include not only Bitcoin, that was an initial focus of guidance, but also numerous cryptocurrencies, stablecoins, tokenized assets, wrap tokens, and non-fungible tokens or NFTs. This has further complicated the taxation of digital assets because some closely resemble securities, some resemble commodities, and others don't resemble either. Therefore, carefully defined terms will be critical in any extension of existing tax provisions to digital assets. For example, we recommend that mark-to-market accounting be extended to dealers and traders of digital assets under the Section 475 framework. The intent of mark-to-market accounting was to simplify tax compliance for assets with a value that can be readily determined, such as securities. There are many digital assets with values that are readily determined and actively traded on multiple digital asset exchanges. To extend mark-to-market accounting to dealers and traders of digital assets, Congress needs to know which digital assets would be eligible for such treatment and then specify the types of activities that would make a taxpayer a dealer in digital assets. For example, narrowly defining actively traded fungible digital assets as those traded on one or more domestic digital asset exchanges would treat digital assets similar to certain securities and commodities. This narrowly defined subset of actively traded digital assets could also be used for other code sections applicable to securities and commodities. Importantly, this standalone definition would circumvent the need to determine whether a specific digital asset is a commodity, security, or other type of asset. For example, Congress could leverage this definition when considering a safe harbor under Section 864 for digital assets. The legislative history of Section 864 indicates that Congress believed it would encourage foreign investment in the U.S. and would keep trading activity in the U.S. This intent would seem to apply to other investment assets, including digital assets. Another tax issue that needs to be resolved via legislation is application of the qualified appraisal exception for charitable contributions of certain digital assets. This exception assumes that certain types of assets have reliable and publicly available values. Therefore, they should not require the expense of hiring a qualified appraiser to determine the value of donated property. Publicly traded securities are among the few types of property available for this exception. Now, because not all digital assets are actively traded on digital asset exchanges, the appraisal exception should not be extended to all digital assets. An overly broad extension may lead to overvaluation of digital assets with speculative values. The qualified appraisal exception should be limited to actively traded fungible digital assets. This aligns with the intention and the benefits offered under the current exception for publicly traded securities, which is to make the charitable contribution process simpler and less costly, and where any possible abuse is unlikely. These three issues do not reflect all digital asset tax issues that can create uncertainty for taxpayers and tax professionals. Some issues are more complex than others, and some have valid arguments on each side. And for some issues, a legislative rule is needed for consistency or to address areas where more than one possible tax interpretation exists. We have addressed additional tax issues in our written testimony. Ultimately, we seek guidance that provides clarity and certainty. Certainty of the tax consequences and reporting obligations arising from digital asset transactions will improve the tax system, not cause people to avoid transactions that otherwise make financial sense, and lead to consistent application of tax rules among all taxpayers. The tax system benefits from clear laws. Everyone plays by the same rules and can meet their compliance obligations with confidence. In addition, tax administration is more efficient. This is what we are requesting when it comes to taxation of digital assets. Thank you for the opportunity to testify. I'm happy to answer any questions you may have.
Thank you very much. And again, I want to thank all of our witnesses for your testimony. Your testimony, as well as your oral testimony, as well as your written testimony, shows just how complex this issue is and how critical it is that we get your expertise in getting it done right. I have just I have a lot of questions, but I'll just go into a couple of them. And first, Ms. Kramer, is for you. And if I understood your testimony correctly, you said that you have some concerns about a de minimis rule. I'm not quite sure whether your concern was whether to have a de minimis provision or whether that we needed to get it exactly right. Could you explain what you were saying there?
In my written testimony, I did go to some length about it. The problem with a de minimis exception is that it is a way that there can be abuse and people can take advantage of it.
Abuse anything.
That's really what
That's right.
the
That's what we do.
concern is. And so talking about
There's fixes.
setting a maximum number, having an income level, maybe having a maximum number of dollar amounts, whatever. And so if there is going to be a de minimis exception provided for digital assets, then it needs to be crafted in a way that is probably more specific than the current exception that we have for foreign currency.
All right, thank you very much. And Mr. Soto, you mentioned de minimis also. Do you agree with Ms. Kramer?
Our position is that a de minimis exception would make sense for this asset class. Ms. Kramer mentioned in her opening statement the kind of difference with currencies where you're required to pay in a foreign country with that foreign currency. I'm not sure that's the policy justification that underlies a foreign currency exemption. To me, these assets, if you go back to the Bitcoin white paper, the concept here is to create a publicly available form of digital cash and to allow individual users to actually take advantage of what blockchains allow for, which is this peer-to-peer value transfer. You need to have a situation where the tax burden doesn't make it completely impossible to conduct transactions in that manner. And so I think there are ways to craft a de minimis exemption that would cover concerns about abuse. But I think, for example, just real quickly, like when you pay for a transaction, for example, in a stablecoin, you also have to pay like a fraction of a cent in the native asset as a transaction fee. And those like fractional cent transactions also are subject to the same tax reporting. And these are the types of difficult tax compliance requirements that make it nearly impossible for individual users to use the technology.
All right, thank you very much. And Mr. Zlotkin, you emphasized parity, and I agree with that. I'd like to ask you to just maybe explain in a little more depth why you believe parity is so critical, and add to that your final comment toward the end of your testimony that we need to have Congress get this right, not just continue to rely on administrative guidance from the IRS.
I did a smart stuff in financial parity. Otherwise penalized compared to financial services. Is this on?
No, it is.
Just pull the mic a little closer. Maybe that'll help.
So we shouldn't be penalized compared to, there are a lot of rules that apply to financial services that do create clarity and durability, and those rules are not applicable to Coinbase and to other similar institutions. So I think financial parity is something that we've advocated very strongly. It puts us sort of in a level playing field with the rest of traditional finance. As to your second question about administrative guidance versus law, my own view is that the only durable way to create sort of a foundation for digital assets is to clarify aspects of the law that are unclear and put that in the code itself. Certainly, we've approached the IRS, we've approached the Treasury, they've been very accommodating. In many instances, sometimes they've been inaccessible in prior years, but I think The only way to really create a durable system functionally to last as a real foundation is the law itself.
Thank you very much. And Ms. Nellen, would you like to comment on any of either the de minimis issue or on the parity issue or any other issue you think should be prioritized?
Yeah, just to note, on the issue of the parity, when you've got rules like for mark-to-market lending, where you're referencing securities or commodities, without any specific rule where the digital assets fall, it can then fall upon a tax practitioner, often a non-lawyer, to figure out, might this digital asset fall into one of those categories? To avoid that, and also you end up with inconsistency as to the interpretation, if there was a category of digital assets that actively traded on a exchange would be added to those provisions, then we would have the definitive answer of, yes, I can identify this digital asset falls into that category. Then it does have consistency with securities, commodities, and certain digital assets.
Well, thank you very much. Senator Wyden.
Thank you, Mr. Chairman. And Ms. Nellen, thank you very much for repeatedly mentioning mark-to-market, because in our billionaire income tax legislation, which now has the support of 22 United States senators, that's one of the key concepts. And you're making it clear it is a regularized part of the tax code, and I appreciate it. Let me go to you, Ms. Kramer, on de minimis, because this is going to be one of the hotly debated aspects of this whole effort. And I want to make sure we're walking this through, carefully, so everybody gets a sense of where we are. So when you use a digital asset to make a purchase, you trigger a gain or a loss, just like if you sold stock. Congress creates the de minimis rule for foreign currency so that taxpayers aren't burdened with tracking gain on personal transactions in local currency abroad. Now, this is where it gets, I think, into the debate. It's been suggested that there be a similar exclusion for digital asset transactions subject to an annual cap. Now, my question is, even if there were to be a de minimis exclusion with a cap, would you still need reporting so that taxpayers know their gains on each transaction to make sure they don't get in trouble with the cap and that sort of thing?
They would need to keep track of the transactions in order to prove compliance, so that as a practical matter, it really wouldn't make a difference.
We're going to ask you some more questions about that in writing, because it strikes me that even if you go forward de minimis with a cap, there are going to be some other aspects to this issue. Let me ask you about mining and staking. If a business issues unrestricted stock for services, is that ordinary income on receipt?
For unrestricted stock,
Yeah.
It's income upon receipt.
Okay. How would this work if miners and stakers received unrestricted digital assets for validation, say, validation services?
Tough question.
If they don't have to pay tax upon receipt the way you would if you got unrestricted stock, then what happens is you don't have to pay tax unless and until you sell it. And you could donate it, you could bequeath it to your heirs. There's all sorts of ways that you would not pay tax on it if it wasn't taxed initially.
All right. Thank you, Mr. Chairman.
Thank you very much. And Senator.
Well, first of all, thank you, Mr. Chairman. And I completely agree that this is a hearing about a novel and complex issue. Listening to testimony, looking at the written testimony, it also strikes me as this is an issue that really should be completely nonpartisan. Not that there won't be some controversies as we start talking about the details of de minimis. I literally have a couple hours worth of questions here, and I'd love to assemble a group like this and probably a broader group to just go through. But first of all, as we approach this, I would like to, kind of like the medical profession, first do no harm. I'll just quick ask you, is there a particular thing that would do harm that you've been hearing? Just quick down the list. I don't want you to spend a whole lot of time on this. Is there something that we really ought to avoid? We'll start with you.
Yeah, I would say the current tax treatment of staking and mining rewards is what's doing harm, and that's one of the main things that needs to be corrected.
But it's happening right now.
Yes.
Yeah, but I'm saying if we would write something to do harm. I mean, but basically, all of you are in agreement, we've got to provide legislation to define these things, to provide clarity. So again, I think the opportunity here is, okay, what are those things that need to be defined? And I know a number of you got very specific suggestions here. I would want to find what does everybody agree on, isolate that, get those definitions in a piece of legislation, then we start haggling over the disagreements. But again, I first want to say, what would we do to really create harm? Ms. Kramer.
Wash that rule.
Well, that's a great question.
I try and have good ones.
Yeah, right. Of course, you asked me first. I would say that one of the things that you could do to avoid harm would be to make the clarification. To have harm would be to unintentionally provide tax subsidies for some people when other people don't get it. And so that's really the harm question. And so the job you have is to work on making sure that if you're doing it intentionally.
So, Mr. Zlatkin, you provided, I think 10 recommendations. By the way, were you able to see each other's testimony before you came here today?
No.
Okay, I would suggest you read it. And then the question I'd like to ask for the record is, what out of all the testimony, what do you all agree on, and where's the disagreement? But Mr. Zlatkin, do you have anything in particular that you think would do harm if we would put something in legislation?
Thank you, Senator. I think that my theme is that there's a lot of potential for over-reporting. We spend a lot of time on that, even in this discussion about de minimis and with stablecoins itself. There's an enormous potential. This is a democratized form of financial asset class where people can use things in ways that weren't done before. And there's a tremendous potential here for over-reporting and burdening the system. It's burdening the system for taxpayers, and it's burdening the system for the IRS. So let's take reporting today, and if you enhance this by over-reporting, by not including a de minimis rule, you're going to have billions of transactions that taxpayers are going to have to report, keep track of. I don't think most taxpayers are prepared for that result. It'll probably hinder the growth of the industry. It will also
when you talk about reporting, again, I want to always keep things as simple as possible. The whole blockchain is based on pretty complex computers, which we have now. So hopefully we could be able to use something like that. Ms. Nellen, representing the AICPA, I would ask you, same question in terms of, is there something that we would do to actually create harm, but also who else, we need all the stakeholders at the table here as you discuss, again, find out what are areas of agreement, what needs definition, how should you properly define it, and start working on the areas of disagreement. So I'd also ask you, who's not represented here? What stakeholders aren't here? But first of all, is there something that we would do that actually do harm?
The only thing I could think of that might do harm if there was some term added that wasn't clear enough, so it then caused people to not act or
Watch that
interpret
rules. They're
incorrectly.
missing
So
watch
making
that
sure
rule.
terms are well defined,
Watch that
with the
rules.
types of transactions that are going on today. So far as stakeholders, I think the folks that are involved, or taxpayers involved, range all over the board. It could be individuals with small investments that are doing all kinds of things, trying to stake, have no idea about record keeping, have no idea about tax consequences. You've got folks with more income engaged in these transactions. You got large companies engaged in various transactions.
Right.
And perhaps, what rule works for one might not be appropriate for another one. Because I think today there is a lot of confusion among a lot of individuals who everywhere from, I thought I didn't have to pay tax until I cashed out at some point, to I don't know how to keep records. And obviously that doesn't excuse them not paying their taxes, but they need some kind of workable guidance, awareness of tools. In fact, actually, I think even enacting legislation is another wake-up call to folks. Hey, you need to be paying attention to what you're doing has tax consequences, and figure them out and deal with them.
So Mr. Chairman, again, I really appreciate you holding this hearing. I hope we can move forward in a very thoughtful way. Let's not do any harm. We've got to get this right. This is incredibly important. And I hope that people contact the committee. They've certainly offered to contact my office. If you're a stakeholder in this, contact us. Let's work through all these issues. Let's find those areas of agreement, and let's be very thoughtful. And again, Senator Wright, I don't think there's any reason for any partisanship in this whatsoever. And there may be some complex issues that need to work through. There'd be different opinions on that, but God, I just think this is a perfect opportunity to do something really important in a completely nonpartisan way. So again, I applaud the committee for doing this.
Thank you. Agreed. Senator Daines.
Chairman, thank you. It's a great topic today. Pleased for the witnesses that are here. Look,
Andrew, you got like 5 minutes before you got to get out of here. So
Yeah.
tell us, like, what's your thoughts so far on this? Is this like something that's actually productive? There were some good questions, that's for sure. But where do you think things are going right here?
Yeah, I mean, overall, it seems like we're having good discussion about some very specific issues that impact a lot of people. De minimis, and for those of you that are hearing de minimis and think it's some weird phrase, what it really means is that small transactions don't need to be reported. And the dollar amount that talking about, usually under $200 or $300 per transaction, that it doesn't need to be reported, no taxes on that. So the example constantly is a cup of coffee, but what they're missing is stable coins are likely, I imagine in very short term, that stable coins are going to be a means of commerce at point of sale.
Right, exactly.
And in order for us to be able to use that, right now, you even have to report stable coins. You have to report them. We need to fix that. And so it's great that they are focusing on a few of these major issues: de minimis, mining and staking rewards, qualified appraisal, trade or business. And at least on Senator Crapo on the Republican side, the majority, Senator Wyden on the minority side, you can see the partisan differences, yet at the same time, there seems, at least from discussion so far, to be an alignment on we need to make improvements. There are issues here, and we need to get it right, but the current system needs to be fixed. So to me, it seems that we're off to a positive start. In fact, even I think someone commented on it. I'd be very interested to see. I don't know how many other hearings are happening today with the government shutdown, right? And some of these senators don't seem to be all that jazzed about here talking about crypto, but at the same time, they're here talking about crypto, right?
Yeah.
So underscores the importance of crypto in our modern economy, as well as tax being one of the most important factors in that success.
Yeah, exactly right. I'm sure those guys aren't happy because it's all shut down, but I mean, these things have to be answered, and I'm glad I don't even know if they even have to actually show up for this hearing, but they did. And I wanted to kind of stop it there where he said, you know what, we shouldn't be partisan. We should reach across the aisle. We should get these things done. I think that's a great message because there's so much divisiveness lately that I think that is a big thing. Anyhow, you've got like 3 minutes. Essentially, there's a couple of questions if we can get to those, and then we can get you out of here.
Let's do it.
Yeah, there's just two. Basama says, can you guys explain if you report with estimates, how will they, IRS, know you reported wrong? How do they know that?
The IRS has been getting better and better at tracing activity, but they don't even have to do that now. And in fact, starting in 2025, all U.S. centralized exchanges, Coinbase, Kraken, all the big ones, they're reporting very detailed information to the IRS on a transaction by transaction level. The IRS requires that every single trade, and that was where this de minimis issue comes in, every single trade, no matter how big or how small, line by line is reported. And their computers compare what they've received versus what's on the tax returns. And they've gotten very, very good at it.
Very, very good. And was this what we were talking about, the 1099 DA rule?
Yeah, exactly.
Okay. And for everybody, if you want to just do a quick search, just put in 1099-DA. We had, it was me, Andrew, and David from CoinLedger talking about this, about how it's going to change things. And just like Andrew said, they pretty much know what you did. So no point in not reporting. It's just how it is, unfortunately. And then Bukasan said, is there a law that if you spend crypto for goods, There is no capital gains tax. I don't believe that is. I
No.
wish it was. That'd be great. I could buy my Lambo. That's a goods. And then not have
Right.
tax.
Yeah. No. If you use crypto for anything, even a slice of pizza or a Lambo, that's a taxable event. Capital gains tax applies.
Exactly. Well,
Yeah.
the good news is that Lambos are close. Everybody take a look at the market. Things are going well. So maybe we should shut down the government more. So anyhow, Andrew, I don't want you to be late. So let's get out of here. Everybody, thanks so much for stopping by. If you want to find Andrew, links in the description. See you guys in the next one. Have a great day. Adios.
Thank you very much.